All right, guys. Welcome to the TSP Weekly Podcast. Here we are again.
All right. It is Halloween as we're recording this. Should have gotten dressed up.
Completely forgot.
Well, I know people are going to be coming to your house. They're not coming to my house, but they're coming to your house.
We never have anybody in our house. We're in the middle of the woods, man. You'd be scary as crap to come to our house.
Yeah, I would. If I were a little kid, I'd be going to my condo complex because you hit a whole bunch of places real quick. But for whatever reason, nobody ever shows up.
Yeah, I've outgrown Halloween. A lot of our friends, I don't know, are probably out there dressing up, going to crazy parties, but I don't have it in me anymore.
Yeah,
just becoming a grumpy old man.
I hear you. Believe me.
All right, what you got for us?
It's been a crazy week. Yeah, it's it's been a kind of a crazy week. We'll get into it. TSP Weekly Podcast, 2 November 2025. So we'll talk about some of the economic highlights. There's definitely huge FOMO and a whole lot of fear in the market right now. And the Hindenburg Omen actually is a reflection of that. And we'll talk about that. And we'll take a look. It's the end of the month, so I don't have today's or Friday's closing price. So the 31st of October is the closing price is not going to be in there, but it's close enough. So we'll see what the monthly close, the monthly charts for the TSP funds, and then the weekly TSP general direction. So this is we got a little bit more information this week than we have been getting. I don't know. I mean, I know the government's obviously not back open, but definitely some of the places that are providing information to trading economics are turned back on. So this is a chart of the Case-Shiller home price index. It's a 1 year chart, right? We're just going back to August of last year. And when we're above zero, it means that home prices are going up. So home prices went up last August, nationally somewhere around 5%. That's been declining. So home prices are very local. So it's possible that wherever you're watching this from, the local housing market could be going up or going down. But nationally, and this is year over year, so nationally, the rate of increase has been going down, right? We're not below zero yet. So nationally, on a year over year basis, housing is still going up. It didn't go up very much in August, but it's still going up, but that's year over year. So actually, when you look at it month over month, it probably is declining nationally. I imagine we'll probably get that on next month's report. But housing is definitely turning over is the bottom line. So we had bond yields continue to fall at these Treasury auctions. We've been talking about this every week for a while now. This week we had 3 month, 6 month, 2 year, and 5 year auctions. All of them sold for lower yields than the prior auction, meaning the government pays a yield, a dividend to people that buy government bonds. And the lower the dividend the government can pay, the less the government is increasing the deficit. So the lower the yield the government can sell these bonds for, the better off we all are. And that's been getting better every year, or every week, every auction. We also had the 30-year mortgage fell a little bit, not a whole lot, but fell to 6.3% from 6.37%. And then one of the big, items this week certainly was the Fed lowering rates by another quarter basis point. So the Fed funds rate range is now 3.75 to 4%. Okay, so also this week we had some big tech earnings. Amazon and Apple had huge earnings, but Meta and Microsoft definitely did not. And you can kind of see that in, reflected in the stock price for all of them. Amazon was up 10% at some point Friday morning. It'd be interesting to see where that closes. But Amazon was way up on the cloud. It wasn't up on Amazon retail. It was up on the cloud. And then Meta and Microsoft, not good. But this week we had the Fed rate cut. Everybody, the Fed cut by 25 basis points, and that's what they did. The market was up, but it was a very interesting up day, and we're going to get to that. And then the next day, the announcement, about the China trade agreement, which by all accounts was great. Most of the tariffs, certainly the 100% additional tariff that was going to go on, is not going on, and they reduced the 20% that was there down to 10%, I think. So a lot of good news as far as trade relations with China goes this week, and that didn't seem to boost the market. Seemingly it should have, but it didn't. Thursday and Friday were not great days. Fed chairman signals that a December rate cut is not guaranteed. I would be amazed if we didn't get a rate cut in December. He's still kind of hanging his hat on this idea that tariffs are ultimately going to be inflationary, but that's is yet to be seen in the data. And April was the beginning of the big tariff scare, and it has not materialized at all. So with unemployment rising and the economy definitely faltering, even though the Fed said the rate cut in December isn't guaranteed, it's I'd be amazed if we didn't get it. Okay, so fear versus optimism. There's a ton of both in the market right now. I'm going to do a couple slides on basically fear, right? Everybody is pointing to the extreme market valuations right now. And it's all true. Like, no matter how you look at it, I mean, this is 1929, 1987, 2000, 2008, and where we are right now. So you got the Buffett indicator, which is, the stock values versus GDP. That's as high as it's ever been, right? Which is why Buffett is sitting in a historical amount of cash right now. But that indicator is as high as it's ever been. You got the PE or Shiller, the Shiller PE ratio is extremely high. Also as high as it's ever been. Maybe a little bit higher in 2000. This is it right here, that green rectangle. It's very, very high. And the S&P 500 price to earnings ratio also extremely high. So here we are right now with all of these three measures of valuation, and they are all higher than they were at the extreme tops when we had these market collapses. And so obviously the implication of this slide is that, the market's going to crash because we have these way over valuations. So that's one kind of fear-based slide, one of many that I found on Twitter at that handle. Jim Bianco, one of the best analysts out there. I know he's not putting this out in terms of trying to encourage fear in the market. He's just putting out the facts. ChatGPT got released on November 29th, 2022. Okay, that was kind of the very beginning of the AI boom. And since then, 41 stocks, which are primarily AI, they could be AI utilities, basically primary AI companies. Since November 29th of 2022, they accounted for 74% of the S&P 500's increase. So 41 stocks accounted for 74% of the gains in the S&P 500 since November 29th, 2022. Right? It's extremely limited, the number of stocks that are driving the market right now. It's just it's kind of amazing because obviously if anything happens to that sector, the rest of the market is very weak. This one was interesting. This was the 28th. We had an up day for the S&P 500. It wasn't up by very much. It was up by 0.23%. But why it got everybody's attention is because literally it was the worst breadth. So, out of the 500 companies in the S&P 500, 104 stocks were up, 398 were down. Right? How do you have a gain on the overall index when only 104, so 20% of the stocks are up, 80% of the stocks are down? And yet the index still was positive for the day. It's another way of looking at how important the Magnificent Seven and the AI sector is. It is the only thing that's driving the market up. And the implication, I'm putting it in the fear category because the implication is that if anything happens to that sector, the index is in big trouble. Okay, there's a couple reasons to be optimistic though, right? This is a chart of consumer discretionary divided by consumer staples. So consumer discretionary, XOY, is the index of what people want. Okay, and it's kind of a measure of risk on, because you want to invest in things like Tesla. Like you would buy a Tesla versus a Corolla if you're feeling good about the economy, you're buying a more expensive car or whatever. So XLY is what people want. XLP is what people need. Toilet paper, toothpaste, stuff like that. So when the line is going up, it's an indication of risk on, right? There's a lot of risk appetite in the market. And so over time, since the bottom in 2009, right, the line has been going up and to the right, and that's good. Since the 2023, well, this was October, basically since the bottom in 2022, once everything got kind of reset at the beginning of the year in 23, consumer discretionary versus consumer staples has gone up. And it's obviously gone up and down over that time, but this was the April low. And since the April low, it's gone straight up and it keeps going up. So we're in a risk on environment, whether you're looking at it from a short-term perspective right here or a longer term perspective. We're still in this risk on environment. And one of the best examples of that really is Tesla. So Tesla peaked back here in 2021, came back up and retested, and now it's retesting again. This is a really good long cup and handle base. So we did a chart of gold last week in the podcast, and it was a much longer base, but this is the same kind of cup and handle base in Tesla. And so if it breaks to the upside, and it's a consumer discretionary stock, breaks to the upside, the market's going to keep going higher. If it fails and breaks down, that'll be a different story. But all indications right now are that the market keeps moving higher. Doesn't mean it's going to do it on a day-to-day basis, but there's a lot of reasons to be optimistic. So the market's super overvalued. There are some very optimistic charts, and there's a lot of pessimistic valuation data. So it's got looking at the fundamentals really concerned because of the levels of valuation. But if you're a technical analyst and you're looking at the charts, there's definitely some reason to still be optimistic. And the Hindenburg Omen kind of captures all of that, okay? So the Hindenburg Omen, it starts when the market is in an uptrend, right? So we know the market has been in an uptrend at least since the April bottom, right? We've barely had any pullback. So once the market's in an uptrend, there are three pieces to the Hindenburg Omen, okay? Market breadth, momentum, and new highs versus new lows. So you need to see, this all happens on the same day, okay? That's why it's such an interesting kind of trigger when it happens, basically. So a large number of stocks, typically over 2.2%. So it says typically, that's the actual rule. It has to be 2.2% of the stocks traded on the New York Stock Exchange must reach both new 52-week highs and new 52-week lows on the same day. So if you think about that, you have stocks, 2.2% of the stocks that are traded on the New York Stock Exchange have to hit new highs, and 2.2% have to hit new lows on the same day. So what kind of investor sentiment does it make sense where you have people pushing stocks to new highs, a significant number of them, right? 2.2% of all the stocks that are traded, and you're pushing 2.2% to new lows, right? It's very unusual when that happens. So that's the first trigger. You have negative momentum. So the McClellan oscillator is a sentiment indicator. It has to be negative on the same day that we get this market breadth trigger. And then highs versus lows, the number of new 52-week highs cannot be more than twice the number of the new 52-week lows. So it's a very specific indicator. It doesn't trigger very often. And then the last thing is you want to see multiple signals. So within a 30-day, they call it a cluster. It can be 2. It's more valuable if it's 3. But if you have 2 times that this indicator triggers in a 30-day period, it's a giant red flag. Okay. So fortunately, stock charts kind of does it for us. Okay, this is a chart from stockcharts.com. It's a 1-year chart of the S&P 500. When you get above, so this is a 3. Okay, when all 3 of those triggers hit, then the overall trigger has hit. Okay, so you can see back here in November last year we had one, and we had one in the middle of December. So I think those were within the 30 days, and so it was definitely putting people on alert. And then it took some amount of time, but then the market rolled over. And then all this time down here, you can have 1 or 2 or none, right? And it doesn't trigger until you get all 3, right? And we just had the second one within a 30-day period on Thursday. Okay, so it's a big red flag for right now. If 30 days goes by and we don't get another trigger, then all this expires and goes away and has to start over. But historically, this is kind of what it's looked like. This is going back. This is 2018 right here. So we had a trigger. These are clusters, right? So each one, it's kind of hard to see, but whenever there's a bunch of them together, they're a cluster. And just because you get the trigger doesn't mean the market's going to roll over. Okay. So we got the trigger here, the market rolled over. We got it here, the market rolled over. Here it did not. Here it did not. This was COVID. Right before COVID, it triggered a whole bunch of times, right? And then right before the rollover in 2022, it triggered 3 times. So where we are right now, it's triggered twice within the 30-day window. So it's a red flag. Doesn't mean the market's going to roll over anytime soon, but it definitely falls into the area of a red flag and something to watch. Okay, so we just completed the month, and so we'll take a look at basically the long-term trend. So each one of these ticks is 1 month of price movement, and we're going back here to 1997. And so what I really wanted to point out is the slope of the line. So, we had the run up into 2000, and the slope of it is relatively shallow, right? We have the same type of slope from the bottom in 2003 to the top in 2007. And even from the bottom in 2009 to 2018, right? The slope of all 3 of these is pretty similar. But once we started injecting a ton of money at the bottom from COVID, the slope of the line goes straight up. And we get the 2022 bear market, and then again, we have the slope of that line is not sustainable. So that's another reason that people are pretty concerned about just the explosive move to the upside. I mean, these things don't generally end well. And the good example was coming off of COVID, we went straight up and then we came straight down. So when you come up and tend to these rounding tops, it gives you some time to get out of the market. But it gets very hard when you get these explosive moves that go straight up, because they tend to go straight down. So nobody's going to pick a top. The market's overvalued. The Hindenburg Omen just triggered. We're doing these explosive blow-off tops. At some point, it's going to end bad. There's just no way of knowing exactly when that's going to be in advance. But now that you know what this looks like in a bigger picture, you can at least prepare and not have your head in the sand thinking that, the market is just going to keep going up, because it's very unlikely for that to happen without some kind of significant pullback. S fund actually looks a little bit better, right? It's nowhere near as overextended as the C fund is. A lot of people think that if this bull rally is going to continue, there needs to be some sector rotation into small caps, which is the S fund, and we've had that, for the last several months. So even if we got a pullback to here, it would be much less than the pullback in the C fund to a whole lot of support. If we got some kind of pullback to support and kept on going, that would be great for the S fund. So the S fund technically actually is in a better position because it's not as overextended. The I fund, so this is the as close to the new I fund as we can get. It includes Hong Kong, and the actual I fund does not, but this is as close as we can get. And it's a little bit different from the Europe Asia Far East Index, which was the old I fund. That index is actually a little bit further along above its prior high from 2007, but the international funds have underperformed the U.S. market for a long time, right, all the way back to 2009, and it's just now starting to break into new highs. So a lot of people think that the I fund is going to be the place to be in the future. All three of the funds tend to go up and down at this more or less together. It's just a matter of magnitude. So if we are rotating into a time period, which has happened before, but if we're rotating into a time period where international funds are outperforming, you'll still get pullbacks here. They just won't pull back as much as U.S. funds. And when they rally, they'll rally further. So I fund is definitely something to keep an eye on. We definitely could be, it's not confirmed yet, but we could be rotating into an international fund outperformance for some period of time. And then the really interesting one actually is bonds. So this is the F fund, and we pointed this out before. Basically, this is the beginning of the F fund in 2004, and we are still below where the F fund started. So if you had been, a 60-40 portfolio, 60% stocks, 40% bonds, any of the gains that you made in bonds were completely wiped out in 2022 and still have not recovered. So a lot of people are looking at this and saying, crypto is overvalued, stocks are overvalued, gold now is overvalued. The only thing left is bonds. So money should rotate into the place that has the most potential upside, which bonds, barring any other asset class, which real estate is at all-time highs. I mean, there aren't too many places you're going to put your money that is really undervalued at this point. So a lot of people, for that reason, are piling into bonds. So it's going to be really interesting to see how all this plays out. From the technical analysis perspective, that 100 line is pretty important, right? We got a little bit below it, back here in the 2000s, and we didn't get too far below it here, and we're above it. So as long as we stay above 100 on the F fund, it's certainly possible that the F fund keeps rallying. But if we get some kind of, if this ends up being a top, F fund rolls over and we spend a lot of time here below that 100 line, it's more likely that bonds can continue to fall. And that's certainly possible given that we were back here, bonds couldn't have gotten much higher because interest rates were basically zero. And so the price of bonds goes up when rates go down. So if rates are at zero, the price of bonds can't really go any higher unless you get negative interest rates. So it's more likely, well, it's possible if rates go up, right? If inflation comes back and the Fed has to push interest rates up, then the price of bonds goes down. So there's so much going on in the world. The only way you can track it realistically is by looking at a price chart. I don't know how people do it without looking at price charts. All right. So in the shorter term, TSP fund direction. So this is a weekly chart of the C fund. Each tick is 1 week of price movement. This is the 20-week moving average line. The RSI indicator and MACD is momentum. And so this was the top. in 2022. We had this 20% decline into the bottom in October 22. We gapped up. This was the April low from this year. Once we gapped up and got above that 20-week moving average line, we've been in this channel, right? And as long as we stay in that channel, the rally continues. We're starting to get overbought in relative strength, but that's fine. The market can stay overbought and keep moving higher, right? And MACD has been starting to weaken, but now we've had the last 2 weeks of increasing momentum in the MACD. So it's entirely possible that the rally continues. There's no point in trying to look at it like a crystal ball. No one's going to pick a top. Eventually, this channel is going to break. And when it does, it'll be the beginning of something changing. And until that happens, the trend is up. Okay. All right. That is about it. There's so much going on. I cannot imagine how people are doing this without looking at price charts. I don't know how you do it.
Well, a lot of people just watch Bloomberg and CNBC and listen to those guys yap on all day long and not really tell them anything, right? They just get more confused, or, they focus on what AI is doing and what, a certain section of the market is doing. And that's because it's more fun to talk about, right? This stuff isn't. Price charts aren't always exciting, but, and that's why you don't see charts a lot on these shows, because to most people, it would be confusing, and most of those guys that are doing the shows couldn't tell you what that price chart is doing, right? Because they don't know anything about technical analysis. They know a lot about commentating. So I've basically stopped watching most of that. But yeah, this is a time unlike we've seen in a long time. A lot of people want to kind of channel this into thinking it's a lot like the .com boom, and I've never really felt like it was, and I was literally in the middle of the .com boom, working in the internet industry at the time. I took a break from the government and was working in an internet service provider, and was really in deep with that. And I could tell you, and you can go look at articles by people a lot smarter than me, but the general consensus is the reason that was so different than the AI boom is because a lot of these companies back during the late 90s and mid 90s didn't really exist. Like, it was fabricated. And I happen to work with one, so I know. Like the ability for people to see inside some of these private companies was like almost impossible. Meaning, a lot of the books were cooked and a lot of things were going on. A lot of it just wasn't real, right? That's not necessarily the case with this now. First of all, there's a lot more transparency and a lot more, they're actually selling things and maybe not necessarily making a profit, but they're making massive revenue, right? That's something that didn't necessarily happen back during. So a lot of these companies weren't real back in the .com boom. That's why they just disappeared. They weren't real to begin with. That's not necessarily the case now. I think what we're going to see is companies that just don't keep up because it's moving so fast. They run out of funding, right? So they're collapsed. It'll be a different kind of bubble, if you will, that probably won't. I don't think it'll be as destructive. So I think that's something positive to kind of look for, right? Is there going to be a correction because of it? I don't know how you can't have it. I just don't. I don't know how you can't have a correction in the market if the AI boom stops. And I don't think it's going to stop. It's just going to, it's going to look different. Some companies are going to win, some companies aren't. But I don't think it's quite the same as like people are just going to disappear off the planet like they did during the .com bubble. I don't think it's the same kind of thing. And I've seen a lot of, smart folks out there that are kind of leaning on that narrative too. Like, hey, this isn't really the same. I think even Powell said that recently, if I remember right. I saw a clip or something where he kind of described it the same way. Yeah. And I think that a lot of people are kind of getting in that camp once they kind of, you got to get under the surface and kind of look at the companies. Are they real? Are they actually making revenue? Do they make a product? Like, is it, because a lot of this stuff during the .com was just fake. It wasn't even real. They were just making things up.
I think what's going to be really interesting in this, and I completely agree with you, it's not the same. It's definitely different and how there's a couple things. So companies were created on the back of the internet. We're not seeing a lot of companies being created. We're seeing AI being used by companies that already exist, but we're not seeing yet a whole lot of new companies being created because of AI. That's like the first thing. But the more important one, I think, is that the internet boom was a positive for job growth. And the narrative, anyway, is that AI is going to take away jobs. And if that turns out not to be the case, then we're going to get a huge boom. Because if unemployment doesn't drastically go up, then the market's going to rip to the upside.
Yeah, it's funny you bring that up. If people remember this huge layoff that Amazon talked about, and AI is getting blamed for it, even by Amazon, right? They're saying, hey, we need to cut costs, and AI is the reason. But what most people aren't seeing is it's not that AI is necessarily taking these jobs. Let's say it's 30,000 people. I think they did 14,000 and they're going to do 16,000. I was talking to somebody who works for Amazon last night, and even they agreed, like internally, people understand what's going on. First of all, there's hundreds of thousands of employees in Amazon, and they doubled during COVID, and they don't need them, right? So that's just math. They don't need the folks anymore. A lot of these jobs are people that really aren't doing anything productive for the company. They're just there. And so 30,000 sounds like a lot. If you were one of the 30,000, it is a lot, right? But they need the money to invest in AI. For them, that's AWS, right? They are the cloud. Like Amazon is the cloud. When you talk about the cloud, it's Amazon. Jerry and I have the cloud in our backyard, right? It's all these data centers. And so Amazon needs that cash to go put that money over there. It's not like AI has come in and taken those 30,000 people's jobs. No, they need money. And so it's not quite the same. And so it's not a robot taking some person in a warehouse and they're replacing that. That's not what's happening with these 30,000. Is that going to happen long term? Yeah, but I think back to your point about will AI create jobs? Yes, but they're going to be different kinds of jobs. And AI is more of a enhancer than a replacer, if that makes sense. You can do your job better and more efficient if you learn how to use AI. It's not necessarily going to replace you. Maybe in some, capacity, but it's more of an enhancer. Where we get the real boom is when you match things like AI and the blockchain, because the blockchain is the new internet, right? It is. Most people don't understand what that means, but it's the new internet. So once those things converge, now you do create all these new companies. You get rid of old ones. You're not going to need a title company for your mortgage anymore. It doesn't exist in the blockchain world. So things like that. But anyway, it's an exciting time, I think. And I think, back to your chart that shows, we've been talking about this literally for the last couple of years, I think. That chart is scary because of the angle of the rise. If the angle of the rise is that steep, like you said, that it's not gonna be a gradual fall. Like, it would be very difficult to have a gradual fall like we've seen in previous decades. Maybe it'll happen. I don't know. Maybe it will look different. Maybe, as we zoom out 20 years from now, it will just look different. But it would be very difficult for that to happen and not be a sudden drop. And then a sudden, I wish the angle would kind of come down a bit again, right? We need a little bit of gradual, because you don't have time to respond to it. It's harder to respond to it, meaning you have to be paying attention all the time, which is why I think shows like ours are important, right? I mean, if you guys are watching this, hopefully you're walking away with at least some grasp of what's happening. Whether you agree with our, thoughts and analysis or not, you can at least understand what's going on, right?
Yeah. I mean, if you just haven't, there's going to be a lot of volatility. There already is. We had a 2.71% down move in the S&P a couple of weeks ago. That was the first day, the first Hindenburg trigger, and we had the second one on Thursday. When the market moves, and it doesn't have to go down to get the Hindenburg trigger. It can go up. It's just that there's so much angst and people moving in different directions. It tends to be an inflection point, and so it doesn't mean that you need to reallocate everything to the G fund. It means you need to start paying attention. It just don't have your head buried in the sand with the expectation that we're going to get 20% return on the C fund every year into infinity, because the fact that it has happened over the last 3 or 4 years means that it's less likely to happen going forward.
Yeah, that's what it comes back to, probabilities and possibilities. It's possible to do anything. It's probable that we're going to get a correction that's not going to feel good. All right, guys, if you like what you hear on our show, please share it with your friends. If you have questions about anything we talked about, put it in the comment section wherever you find this video. If there's no comment section, send it over to us at support@growmytsp.com, and the support team will share it with us. We hope you guys are having, we're still going through this shutdown. I know it's affecting a lot of people, and it's payday as far as I think today for most of the government, because the weekend is the first. So hopefully you're hanging in there, and a lot of resources out there with different banks. Make sure try to stay positive. This too shall pass. All right, guys, and hope you enjoyed your Halloween. Hope everybody's safe, and we will talk to you next time.